Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$20.61. That's the closing price for Intuitive Machines, ticker LUNR, today, Friday, January 23, 2026. But look, if you're just glancing at that headline price on your phone, you are missing the absolute violence churning just under the surface. I mean, we are seeing daily volume consistently hammering above 10 million shares. Just yesterday on the 22nd, we watched a nearly 7.5% intraday swing, just whipping between $19.45 and $20.90. The technicals are, well, they're screaming that something massive is about to happen. We're sitting in a textbook golden cross, where the 50-day moving average crosses above the 200-day, and we're trading well above that 1345 support line. We are just banging our heads against resistance near the 52-week high. I mean, the coil is wound tight.
It is wound tight, I'll give you that. But, the physics of a coiled spring work both ways. It can launch you to the stratosphere, or it can snap back and hit you right in the face. Because while you see a golden cross and all this momentum, I look at that same chart and what I see is just extreme chop. We've been trapped in this really frustrating $19 to $22 range, just churning shares ever since the acquisition news dropped. The market is clearly struggling to price a company that's trying to be two completely contradictory things at once. On one hand, you have this new glossy narrative of a stable defense contractor. And on the other, you've got a stock that still acts like a gambling chip waiting for the roulette wheel to spin on February 26th.
And that tension is exactly what we need to unpack today. Is LUNR still just a speculative lunar play, or has the market completely missed the fundamental transformation that happened on January 13th? My argument is, well, it's pretty simple. The market is severely mispricing Intuitive Machines. Investors are treating it like a volatile pre-revenue science project. But the reality is, with the $800 million acquisition of LUNR Space Systems, they have effectively crossed the Rubicon. They aren't just going to the moon anymore. They have become a diversified infrastructure prime.
I understand why you want to frame it that way. It's a comforting narrative for shareholders, right? The idea that they've bought their way to safety. But I come at this from a different angle. You can buy all the revenue streams you want, but you cannot buy your way out of execution risk. And you certainly can't buy your way out of bad insider sentiment. And the signals I'm seeing from the people inside the building, specifically the co-founder, are flashing bright red. We are weeks away from the IM-2 Athena mission, arguably the most critical moment in the company's history, and we're seeing massive, massive insider selling. That doesn't scream confidence to me. It screams exit liquidity.
I think you're reading a little too much into a single transaction there and missing the forest for the trees. But, okay, let's lay out the core cases before we really dissect those trades. Here's the reality the market is ignoring. The LUNR integration creates a combined company with over $850 million in projected 2026 revenue, and we're talking about a total backlog of $920 million. Let's just pause on that number. This isn't maybe we'll get a contract someday. This is booked business. So even if the lunar mission fails, and I really don't believe it will, the LUNR put is real. That revenue from national security, space, and commercial satellites puts a hard floor under this stock. The risk-reward is now completely asymmetric to the upside.
I'm sorry, I just don't buy the floor argument yet. Not when the valuation is this messy. You're glossing over the cost of that acquisition. They diluted shareholders by, 24.3 million new shares to make this deal happen? That is a significant slice of the pie just gone. And let's look at the man who knows the tech better than anyone, Timothy Crane, co-founder SVP. On January 15th, just last week, he sold 170,185 shares. That's about $3.41 million. But the dollar amount, it matters less than the percentage. He dumped 36.32% of his holdings, over a third of his stake gone, right before the most critical launch in the company's history. So if the space prime thesis is so watertight, why is the co-founder heading for the exits?
It's a fair question and one we have to address. But let's be precise. Executives sell for lots of reasons: taxes, diversification, buying a house, CEO Steve Altimus, notably, held his position. He sold less than 0.1% purely for tax purposes.
If there was a systemic lack of confidence, you'd see a rush for the door from the entire C-suite. But let's dig into the substance of what they actually bought with Lantrice, because that explains why the floor is real. Let's talk about this transformation versus the current market structure.
Go ahead, but keep in mind, that market structure is currently dominated by short sellers and dark pools. And that's a mechanism we really need to explain, because it's suppressing all the price action you're so excited about.
We will, but the fundamental value driver here is strategic. Lanteris is the old Maxar Space Systems. This isn't some garage startup. This is deep heritage in GEO and MEO satellites. But crucially, they acquired manufacturing facilities in California, Palo Alto, and San Jose. Why does that matter? Because those facilities are the ticket to entry for the Golden Dome.
You're referring to the SHIELD architecture?
Exactly. The Missile Defense Agency's SHIELD architecture. Intuitive Machines is now an IDIQ awardee on Line 914. For those listening who don't spend their days reading government contracts, IDIQ means indefinite delivery, indefinite quantity. It means they're pre-vetted and cleared to bid on task orders without jumping through all the hoops every single time. They've moved from experimental NASA tasks to being eligible for multi-billion-dollar missile defense work. H.C. Wainwright estimates the lifetime value of these things could be over $500 billion across the industry. LUNR now has the clearance and the factories to bid on that as a prime. That's why I say they've crossed the Rubicon. They are no longer dependent on whether a single lander tips over or not.
That is a compelling argument for the long term. I'll grant you that. The Golden Dome is a massive pot of gold. But here's the problem. The market isn't trading the 2030 defense budget. It's trading the technicals right now. And the data is ugly. We have short interests sitting at 23.24% of the float. That is over 26 million shares sold short. But the really interesting part, the part you mentioned, is the dark pool activity.
You're seeing the arbitrage.
It's textbook deal arbitrage. We're seeing 48 to 65% of the daily volume happening off exchange. And for the listeners, dark pools aren't some sinister conspiracy. They're private exchanges institutions use to move large blocks of stock without immediately tanking the public price. So here's what's likely happening. The Lanteris deal involved $350 million in stock. The investors who receive that stock are likely hedging. They're locking in their value immediately by shorting the stock in these dark pools. They're just capturing the spread. But what this does is it creates a mechanical ceiling. Every time the stock tries to rally past $21, $22, the selling pressure just kicks in. It doesn't matter how good the Golden Dome story is if half the volume is mechanical selling designed to cap the price.
I agree that the arbitrage is creating a temporary ceiling. I think that explains the chop you mentioned earlier perfectly. But I view that differently. That is exactly why the opportunity exists for the retail investor or a long-term fund. That selling pressure is artificial. It's not fundamental. It's just financial plumbing. And once that arbitrage unwinds, or more likely, once we get a catalyst strong enough to just blow through that ceiling, the move will be explosive. And that brings us to the catalyst, the IM-2 Athena mission.
The catalyst, or the cliff, because that's really what it represents.
Okay, let's look at the upside first. The window opens February 26th. Launch is on a SpaceX Falcon 9. We're going to the South Pole, specifically the Mons Mutten region. This isn't just a plant the flag mission. They're deploying the Prime 1 ice drill for NASA. If they stick this landing, if they drill into the lunar surface and actually find ice, it validates the entire tech stack. It proves they can do in-situ resource utilization, which is the holy grail of deep space. It moves them from delivery company to infrastructure utility.
If they stick the landing. And that is a massive if.
But they've learned from IM-1. The Odysseus mission was a success. It was the first commercial lander to reach the surface. But yes, it was messy. We know about the laser rangefinder safety switch that was accidentally left on. We know about the lateral velocity issues that caused the tip. The engineering teams have fixed that. They've updated the software. They've resolved those procedural flaws. A successful landing triggers a repricing to $30 plus, immediately. And with 23% short interest, you are looking at a massive squeeze where shorts are forced to buy back at any price, driving the stock vertical.
I see the bullish case, but you're just glossing over the physics of it. Landing at the South Pole is exponentially harder than landing near the equator. At the equator, the lighting is flat, it's predictable. At the South Pole, the sun is barely above the horizon. This creates these long, deep shadows. A small rock casts a shadow that looks like a crater. It's an optical nightmare for the navigation cameras. The terrain is rugged. This is like double black diamond skiing compared to the bunny hill they were on before. And let's not forget the tip-over risk. If Athena tips over like Odysseus did, the market is going to label the Nova Sea lander as fundamentally unstable. You can't be a logistics prime if your delivery truck falls over every time it parks.
The Nova Sea is a proven vehicle that made it to the surface alive. It just needs to stick the landing upright. The iteration speed is what matters here.
Yeah, but the smart money isn't betting on that iteration speed. Have you looked at the correlation with prediction markets? I've been tracking the human moon landing in 2026 contract on Polymarket. The odds are trading at less than 10%. Now, I know IM2 is robotic, not human, but the two are linked in sentiment. When the prediction markets get bearish on Artemis timelines, lunar stock tends to lag and drop shortly after. The people betting real money on this stuff do not believe everything is going to go perfectly. If IM2 crashes, you lose that lunar premium entirely.
Okay, so where do you think the stock goes in a failure scenario? Let's play that out.
If they crash, the stock goes to $10 or $12. That's the value of the LUNR's assets and the backlog, stripped of all the lunar hype. That's a 50% drawdown from here. And that is why Crane's selling 36% of his shares matters so much. He isn't just buying a beach house. He's hedging against that exact 50% drop. He knows how hard the South Pole is better than you or I do.
I disagree with the severity of that drop. I think the LUNR's put holds higher than 12, maybe closer to 15, because the cash flow is real. But let's look at the valuation relative to its peers, because that is where the disconnect is it's most obvious. Look at Rocket Lab, RKLB.
Everyone loves to compare them to Rocket Lab. It's a favorite pastime of the bulls.
Because it's the relevant benchmark. Rocket Lab is trading at more than 20 times their 2026 sales estimates. 20 times! Intuitive Machines post-LUNR has similar near-term revenue projections, over $850 million, yet it's trading at roughly 4.5 times 2026 sales. That gap is absurd. Even if you argue Rocket Lab deserves a premium, a 4x discrepancy is totally unjustified. LUNR is being treated like Redwire, which trades at a 3x multiple, but LUNR has the lunar kicker that Redwire doesn't. We have the potential for exponential growth that Redwire simply doesn't have.
That comparison is flawed, and here's why. Rocket Lab commands that premium because they have a near monopoly on small launch, and their Neutron rocket promises software-like margins on future constellations. Investors see Rocket Lab as a platform company, almost like a tech stock. Intuitive Machines, especially now, is a hardware manufacturer. They build satellite buses and landers. Hardware margins are lower. It's a tough capital-intensive business. You just don't get a SaaS multiple for building satellite buses. That's why the market is pricing them closer to Redwire.
But defense primes don't trade at 3x sales either once they're established, and LUNR is becoming a prime. You're ignoring the strategic value of being a prime. The ability to be the primary contractor on a billion-dollar defense shield carries a premium that Redwire, which is mostly a component supplier, does not get. LUNR gives them the classified facilities, the cleared workforce, and the track record to sit at the big table. That multiple expansion just hasn't happened yet.
I'll concede that the multiple expansion could happen, but it takes time. The market doesn't just award you prime status overnight because you bought a company. You have to prove you can run it. And there's another structural risk we haven't touched on, the ETF factor. Have you seen the LUNR ETF?
The 2x leverage long ETF? Yeah, it launched back on January 13th.
Exactly. It's small right now, sure, maybe $2 million in assets, but it adds structural volatility. It's a leverage trap. For those who don't know, leveraged ETFs have to rebalance daily. So if LUNR drops on bad news, say a launch delay, that ETF has to sell shares at the end of the day to maintain its leverage ratio. It makes the downside worse. It creates a feedback loop. So a 10% drop on news could become a 12 or 13% drop because of that ETF selling. It makes the stock significantly more dangerous to hold through a binary event.
That mechanic works both ways, though. If we get the squeeze on predicting, the ETF has to buy, adding fuel to the fire. It amplifies the momentum. But let's step back to the core valuation. You mentioned the conglomerate discount. I argue that the market is just confused right now. It doesn't know how to value the combination of a boring, profitable satellite maker and a high-risk lunar explorer.
And usually, when confusion exists, opportunity exists. The market is pricing in the confusion, not the combined value.
The market is pricing in the dilution and the cash burn. Remember, they have 920 million in backlog, which is great, but they also have a high burn rate to support the lunar operations. Landing on the moon is expensive. If IM2 fails, do they need to raise capital again? They have almost 118 million shares outstanding now. If they have to do a secondary offering at $10 because the lander crashed, that dilution is going to be painful for anyone who bought in at 20.
But management has guided that the Lanteris acquisition is accretive to EBITDA within the first year. That is key. Lanteris generates cash. That cash flow funds the lunar R&D. That is the genius of the deal. They don't need to go back to the equity markets with a tin cup if they have positive EBITDA flowing from the defense side. They've self-funded their own ambition.
Accretive is a spreadsheet term. Real life is messier. Integrating a massive acquisition is difficult. You have cultural clashes, operational friction. You have the old space guys from Maxar trying to work with the new space cowboys. And doing all that while trying to land on the South Pole, it's a lot of spinning plates. And again, I just keep coming back to that insider signal. If the cash flow was so secure, if the prime status was locked in, why did Timothy Crane take $3.4 million off the table?
You are so hung up on Crane.
Because he's the co-founder. It's the loudest signal in the room. When the chef refuses to eat his own meal, you should worry about the food. He knows the burn rate. He knows the integration challenges. He knows the lunar terrain. And he sold 36% of his stake. You can talk about EBITDA all day, but actions speak louder than spreadsheets.
It is one data point. The institutional flows tell a different story. We're seeing funds like Susquehanna increasing their stakes. We're seeing new entrants like Jump Financial positioning for this event. The smart money isn't just selling. The volatility traders are piling in because they see the mispricing.
Volatility traders are piling in because they love the variance, not because they love the company. They are there to trade the swing, not to hold the stock for 10 years. They'll dump it the second the momentum breaks.
But that brings us right to the conclusion. The next 30 days are going to determine which one of us is right.
They absolutely are.
My final position is this. The space prime transition is real. You can be skeptical of the moon mission, fine, but you can't deny the $920 million backlog or the access to the Golden Dome. At $20.61, you are buying a stable defense contractor for a bargain, and you're getting a free option on the future of the lunar economy. If Athena lands upright, this stock doesn't just go to 25, it breaks out to 35 or 40. The upside is asymmetrical. You are risking $8 of downside for $20 of upside.
And my position remains that the market is right to keep Lunar in the penalty box. The conglomerate discount is justified until they prove they can integrate Lanteris without stumbling. The insider selling from the co-founder is a massive red flag that is impossible to ignore. 36% is not a trim, it's an evacuation. And while Lanteris provides a floor somewhere around $12, the execution risk at the South Pole is extreme. You're buying a coin flip, and the people holding the coin are selling their shares.
The window opens February 26th. The option is either going to expire worthless or go deep in the money.
And until then, expect the chop to continue.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.